Hello and welcome back to the ATZ channel. Today I have the privilege and honor to introduce my good friend Ravi Maniar from Azure Financial Wealth. He's an independent financial advisor and a wealth manager, one of the traits that you have, and years of experience, especially in this sector. So I'd like to pass you over to Ravi for a quick introduction and we'll crack on with it.
Yeah, afternoon everybody. My name is Ravi Maniar. Yep, I'm an independent financial advisor. I've been advising for over 18 years and been loving every moment of it. Lots of changes in the financial world, and it's always very interesting to make sure that I'm keeping my clients up to date with changes and how to make a better decision with their finances.
So today it's like a double-edged sword we've got you here. One, to understand what you do.
Sure.
Two, can our viewers understand what you do as well? And on the other side, for me, it's just how does it differ from other financial advisors out there? And the first question I get asked by all my clients is an IFA or a wealth manager. You know, we're too small, we're too big, where do we sit in the process? So in a nutshell, can anybody access an IFA, or is it only for those uber rich, as it traditionally is?
As it traditionally is. The answer is yes. Anyone can access a financial advisor at any stage. The difference is how complex is the need that you need answering, okay? Sometimes if you're just looking to set up an account, it might actually be easier to go and to a bank or something like that because you don't have enough to be able to make it worthwhile. The more complex it gets, that's when you probably might need more financial advice.
So you're like a broker for investing money?
I wouldn't say broker.
We're a broker for what we do.
You're broker. Yeah, we're advisors. Everything that we do is that we advise clients on the best possible outcome for their wealth. And we really do fit in that space in terms of we're fully independent. Well, I am, and you know, there's lots of regulations around what we're doing. How do we give the right advice?
So that's you give them the right advice to it. So do you actually go to market for these people, or your clients, should I say, and you make sure they're looking at this option, that option, does it meet their plans and their growth plans, whether it's stability, growth. You mentioned something earlier on, and we were talking before about passing wealth down. So bringing back my other question is, in a world of online investing with instant information available to them, right? What's the true value of someone like yourself? You know, can AI replace you? Can we go into ChatGPT and say, I've got X, Y, Z, how do I invest it?
That's a really good question. We do get that quite a few times actually. And the way to answer that is if you had £10,000, how much would you trust AI to give you that piece of advice? Okay. Compared to if you had £500,000, would you trust AI to give you the best possible outcome?
Fair enough. Same thing in our industry. When people want to borrow money, they go, oh, in ChatGPT products this, I can apply for this, but do you really understand what it is, right? So you're coming from an education perspective where the clients need to understand what's going on.
Yeah.
So it's not about numbers, charts, yields, returns. For you, it's just, does it fit their model, right?
Correct.
And for me, it boils down to, not for me, but for people as well, it's the emotion of the investment, because this is someone's lifelong earnings, right?
Correct.
My aspect of our business is we'll help you borrow the money to build your wealth. Once you've made your wealth and you got your business successful, they come and see someone like yourself to secure it and to pass it down or sell it or live off it, right?
Correct.
So when it comes to borrowing, the risk is slightly different. You know, there's an element of will it work, won't it work kind of scenario, because you're running a business, right?
Yeah.
But once you've got it, letting go is the hardest bit. Would you agree?
Yeah, I would agree. Yes. Yeah.
So most people, when they make these investments with you, they're putting a lot of trust.
Yes.
And that's where history comes into play, relationships that you have with your investors. We have lenders, you have investors right now.
Correct.
So in a world of such an emotional turmoil, how do you manage that process?
Well, financial advising has been around for many, many years, okay? And they're constantly updating and changing regulations when it comes to providing financial advice. We've always got the core client at the heart of everything that we do. And we are probably one of the highly regulated practices that are out there. So ultimately, anything that we're advising clients on, you know, we have, you know, the Financial Conduct Authority, we've got the Financial Ombudsman Service. So there's always checks and balances with what we're doing.
You've got something you're checking into, right? Like the head teacher of a school. You've got to keep yourself
correct.
Track,
so there's
right?
always that in the background. But ultimately, as advisors and brokers and whatnot, you just want to give the best quality advice to the person that's in front of you so they come back.
And also, I definitely agree with that concept. Then it also boils down to, do certain investment funds pay more in terms of comms, right? This is where we get, as an industry, we're in a brokering world. there are certain lenders that pay more, certain lenders that don't pay more, and certain lenders are suited for the individual.
Yep.
But in your industry, is it the same as well?
No. So that all changed pretty much in 2012. So the industry basically got rid of all of that type of payments, commissions and whatnot. So we are fee based. So anything that we do for a client, we will arrange a fee up front, and the client pays that cost.
So the investment houses don't pay you anything.
They do not pay anything. So therefore, whatever we're recommending for the client, they know that at that point of time, it is the right product, the right provider, the right investment strategy for the client at that point.
In terms of investment strategies, there are multiple ones available out there, right?
Yes.
You've got your very secure, safe, money's tucked away, but it makes you X, Y, Z a month, right?
Yep.
Or you've got the extreme, which is, well, I like to play sometimes every now and then. Don't tell me wrong. My wife would not agree with it, but it's just where the fun happens, right?
Yeah.
Where you can make massive wealth. How do you determine where a client sits in that placement?
So we kind of touched on it at the very beginning. It comes down to a couple of things. How much are you investing? Because that's generally a guide as to how much risk you're willing to take. So if you had £10,000, would you take a high level of risk with £10,000? Well, if that's all the money that you had, maybe not. But if it was 10,000 out of £500,000, then you're quite happy to take a higher level of risk with that because you've got £490,000 not doing much. So it comes down to how much are we playing with per se.
Yeah.
And then also, what is the time frame? What is the actual goal? What are we trying to achieve? If you've got a very short time frame, then we might have to take a higher level of risk to get you there. If you've got a long time frame, then we'll balance it out.
So all this is a long-term game, right?
Well, again, it's what is your goal? You know, some people might be saying that we need to have some money that's earning more than a bank account because we want to send our children to university, which is in about 5 or 6 years' time.
So the bank will pay you an average, what, 4% roughly?
4%, yeah. Take away inflation, take away taxes, depending on where you are in the tax bracket, you're down to like maybe 2-3% off inflation if you're lucky. And ultimately the bank rates are coming down. We had a very good period of around 5 and 6% in the last few years. So the rates are tailing off.
That's the rate driven. So in our world,
leave it in a bank,
definitely in our world, in terms of the finance side of things, we're not really bothered about the rates. What you can do with the money in terms of investing in the business. But from an investment perspective or a saving perspective, it's all about the rate, right?
Correct.
So it helps you build, and it also brings me down to another point. It helps you build financial resilience, right? So people are looking for financial resilience and financial growth and stability within themselves. The simple question, it's been bugging me for ages, believe it or not, is how do you gauge your client's financial freedom? What does the word financial freedom actually mean?
You could ask 5 people that question and they will all have a different answer. And it is, what does it mean to you? What are the goals that you individually want to achieve compared to the person sitting next to you?
I'm interested in your goals. I'm interested in your goals.
You're interested in my goals?
Reason why, because you live and breathe this world, right?
I do.
So you live and breathe the finance world or the investment world. So that's your bread and butter, and you've got passion that goes with it as well, right?
Yep.
Like we're from the brokerage world, so we enjoy that side of things. I'm always intrigued to understand, okay, what's someone's vision? What's their goal? Where do they want to be? What's their drive? What gets them out of bed in the morning, right? Yeah. That's the thing. And looking at spreadsheets is not pretty at the end of the day.
No.
But then you've also got a plan to go with it. So what is your definition of financial freedom?
So for me is probably one of the most important ones is early retirement. Okay, so the idea that I have a pot of money that I can depend on and basically give up work. Okay, and that should be able to sustain my lifestyle. The question is, what lifestyle do I want to have? Okay, and that we can go to a completely different conversation with that. However, early retirement, which is before the age of 67 and 68. Okay. So my goal really is to retire at the age of 60.
So you got a good 4 years ahead of you still anyway.
4 years ahead of me.
I said 40, not 4.
4 years. I thought, whoa, hang on, wait a minute. Okay.
Now 40, okay.
Yeah. So where are we there? So there's still plenty of time. However, within that, there's mortgages you've got to pay off. There's holidays you still want to do. I love my cars. I love going and driving nice cars.
So you've got an element of debt in your life as well, right?
Exactly. So you just need to balance a few things out, okay? And there's always to live abroad and do what you want to do there. So there's kind of things that I'm gearing up to get my way there.
So you've got a plan.
100%.
So pretty much like in business, people have a cash flow forecast or their business plan. So you've got a life plan to go with it. So from an IFA's perspective, you help clients build up a life plan, which is based upon them, not on their businesses. But they've started up in business, but now they're looking at it for themselves. A lot of people don't invest in themselves. which is the biggest challenge right now, is how do you get them to do that?
Yeah, it's really good that you actually mentioned that. As a business owner, you're absolutely right. You spend a lot of time on your business, your plan, money in, money out. What can you afford to do to expand and to grow? Where do you borrow? Where do you not borrow, and whatnot? You look at all of the numbers. Once you've done all that, and as the director of the company, you realise that they don't really do much for themselves.
No.
You know, they're thinking that the business is their way out and whatnot. But in that time, they could be using the business in a more efficient way to extract profits and invest in their own future. And they missed that part of it. So you're absolutely right. Whenever you set up your own goal, you do need a business plan for yourself and a business for the business. So
the business could have profits sitting there, retained profits, right?
Yeah.
So we help clients invest that in other assets, whether it's buying commercial property or having a subsidiary company set up, intercompany loans, all that kind of jazz to go with it. And I know last time we spoke, you mentioned something about people utilizing pension pots, which are sitting there, right? Tell us a bit more detail. How can somebody with a pension pot sitting there, think a SIP or a... Educate me on that process.
Yeah, so pensions are probably the most underused investment strategy that's out there. They're very versatile, and you can definitely use your business to invest into a pension. And within that pension, you can purchase commercial property under the business name, and it sits separately to anything that's there. Okay. And once that you've bought that kind of property, you're then any capital growth, any rent that's paid stays in the pension, stays in that property, and it's completely
so it's completely off the radar.
Correct.
I say off the radar in the sense that it's under the books kind of thing. It's on the books, but completely parked away to one side. So that pension pot where we're earning you, call it 10% in a pension fund managed by somebody else, you're now in control of it. So you can bring it back home again, right?
Correct.
So imagine I've got £500,000 in my pension pot, but I want to buy a commercial premises of £1 million.
Yep.
The other £500,000, can that be borrowed?
Yes, you can. However, you can only borrow up to 50% of the pension. Okay, so the max you'll be able to do is get about 750,000.
Fine. So they give you the leads to go with it, right?
Yeah.
So you normally speak to a broker. You speak
Correct.
to an independent brokerage firm that can help.
Yeah.
There's a couple of specific products for that, and mine was a leading question. To be fair, I do want to bring you back to where my point was anyway. So there was a malice to go with it, but then that point is that we can help fund that. So now, if you have a business running out in a warehouse, for example, but you've got money sitting in a pension pot, you can buy that premises within your own pension, still trade your business from there, pay rent back to yourself indirectly, and grow. So this is another strategy to business that people don't really think about, because what we found over the years is the advice given to everybody is not the same.
Yep.
Some of these tips and tricks you're talking about today was only accessible to the uber rich at one point. People who paid ridiculous sums of money for advice. We want to open up this channel to people that can have this advice, have this education, and have this support, and bring people like yourselves on board to pass it down and just grow synergies between everybody. And that's where we're coming from. Would you agree? I
do agree. Yes, I do. I do feel that there's lots of areas where we can work together if you get the right client and giving them the right advice. And you're right, it is underutilized, and it's a great way to generate wealth and create further assets moving forward.
Definitely. Another thing, when clients do their investments,
Yep.
So when they're looking to do investment or to go, do their personal values come into play, or personal ethics?
Explain that a bit more.
So depending what fund you're investing in, do they have a choice in what kind of funds they want to go into, the type of funds they're investing in? And the example I use is major share funds right now, BAE Systems and all these other guys. People invest in BP to go with it. Yes, they make great returns, but sometimes they're not the most ethical product in the world, right?
Yeah.
And how do you, from an independent perspective, look at your clients and say, is this the right investment or not?
Yeah, so we specifically have portfolios and fund managers that deal with what they call ethical and social and responsible way of investing. So there's a couple of ways that we can do it. We can either exclude certain areas, so they don't want to do anything with petroleum, they don't want anything to do with arms or anything to do with war, and we can take those out. Or they want to positively screen something and they say we want an investment that deals more with using recyclable energy and things like that. So we can then gear the investment strategy that way. So there are more of these funds coming out now, which is really good because it is a hot topic. So depending on whatever the client's wishes are, and if they want anything specific in their portfolio, we can tailor to that.
Wow, so the same way that we can tailor a product to meet our clients' requirements and which lender we go towards, you can tailor their product
Yes.
in terms of how they want to invest, which ethically suits them. Because the lending market's changed as well, believe it or not. There's ethical products out there which are ethically lending, but they're not based on funds and like they're investing like you guys are there, but they're investing in gold and platinum. So they're trading differently from an ethical perspective. So I do agree the market is evolving. It's going back to not just putting into a fund and hoping for the best type of things. But I've got a real question for you. When the market crashes, right, what do you do? Do you not turn the laptop on all day or just go off the radar? How do you deal with it?
What can you do when the market crashes?
How do you deal with clients giving you a call? If their portfolio changes, what's the angle at the end of it? And on the dark days when things go wrong,
Yep.
how do we recover from it?
So two things. When the market crashes, you do nothing. Okay? You do absolutely nothing. You continue as it is, because at the end of the day, it's going to recover. You just don't know when it's going to recover. So you don't want that to kind of make your decision as to cash out, because you'll be cashing out at the lowest level. So you've actually lost money. If you leave it the way it is, it's only on paper you've lost. And within a month, 2 months, maybe a little bit longer, you will recover and make your money back. And pretty much that's exactly what happened in April. Markets dropped by about 20% with Donald Trump.
Yeah.
Today,
Bit of a liability, isn't it?
bit of a liability. Today, you are plus 20, about 25% up. So actually, you're way more than where you were from before. So you don't do anything. You continue as you are, because and this is going back to your goal and what's your long-term strategy. Okay, you just continue on your path. The other kind of strategy to do is actually invest more money. As soon as the market tanks, you put more money back into the pot.
Right. Because it's understanding the numbers to go with it, right? It's evolution, the numbers to go with it.
Correct,
And looking
yeah.
at the plan to go with it. By not having a plan, not knowing the outcome, not discussing the outcome,
Yeah.
not working out both sides of the story, makes it very difficult to build and grow, right? That's fine.
Just off the back of that, you're absolutely right. If you don't have a plan and you're guided by just what you see on a day-to-day basis, that's where you're going to be making the worst decisions and actually losing money. So again, having that phone call and someone giving you a call to say, look, this is what's going on. What do I need to do about it? Most of the time is that reassurance, everything is fine. And that's where brokers and advisors come in to reassure the client that everything is actually okay.
So at that point, you're actually in front of the clients a lot more. You're giving more face time. You're trying to help them and support them in the process, provide that emotional support. Because finance is about more than one thing. It's not just the numbers in the bank. It's the emotional trait that goes with it. And dealing in these kind of marketplaces, it becomes very, very emotional.
It is.
Like you're dealing with people's life savings at the end of the day. And at that stage, people are very, very... They're touchy, aren't they?
They are touchy, let's be honest. They've trusted you to invest their money. But I prefer it if something has happened in the marketplace that they do call me. Because if they don't call me, I actually get worried that they're doing something in the background that I'm not aware of. So I prefer that if they're not happy or comfortable about anything, that they actually give me a call so I can just hear what their concerns are and then talk them through it. So
why invest in funds and all these kind of bonds when I could just go and buy crypto? So why would somebody not go down that route? You know, I've looked at it. I don't understand it. But people are out there who I've seen these things on, you might have seen them on Instagram, you know, billionaires or millionaires at the age of 21 or 15 or whatever. How's that possible? So why can't anybody else do that?
First and foremost, I don't advise on crypto. I have done crypto myself as an individual. However, I do not advise my clients to go into crypto. Firstly, it's an unregulated area, so you won't be covered under the FCA or anything like that should anything go wrong with your investment. It's highly volatile. There's been lots and lots of crypto coins being generated and made, and you've lost all of your money. Okay.
There's meme coins or something they call them.
Exactly that. Yeah. Exactly that. And then you do have your mainstream kind of cryptos and whatnot. But the same kind of, goals apply in terms of what are you investing for? What is the long-term strategy of this? And are you happy to lose every single penny of this investment? If the answers are yes, then you can go and do some crypto. But you kind of said, I've looked into it. I don't understand it, but there's about 99% people who, when you say they're youngsters and they're billionaires, it's fluke, okay? They have literally someone that said to them, have a look at this, some YouTube thing, and they've got some pocket money at home. They haven't got mortgage to pay. They haven't got rent to pay. They haven't got anything like this. they've got £1,000 and they bought £1,000 worth of something which was like £1, and they have done really well.
So luck versus preparation. Is that luck versus preparation?
100%, 100%. There is no rhyme or rhythm with crypto. It really is basically depending on what's happening, what
No
the thoughts
skill,
are.
just a random.
It really is like, I think Elon Musk at one point came out with something, and I think Bitcoin tanked by God knows how much. So it is a highly volatile, speculative investment, and that's why something like it's not anything that we would.
So what is a safe investment then? What dictates a safe investment?
Well, let me ask you a question: Is leaving money in under your mattress a safe investment?
Depends on the neighborhood.
Yeah. What else?
If it's going to depreciate, get lost, eaten by the rats. I don't know. Like Pablo Escobar lost more money eaten by rats than anything else, wasn't it?
There you go. So in actual fact, the answer is there's nothing out there that's risk free. Okay. There's always an element of risk
100%.
with what you're doing. So again, it will come down to what amount of risk are you willing to take? Okay, because even if you leave it in a bank account and you see your £10,000 a day, in 12 months' time, you'll see £10,000 in the account.
Depends on the bank though. If it's Northern Rock, you're kind of screwed, aren't you?
Well, yeah, thankfully there's none of that anymore. But you put 10,000 in now, you get 10,000 next year. You still have your capital, right? However, in a whole year, the cost of living has gone up.
Yeah, inflation on 4%, 5%. Right
Exactly. So your £10,000 today isn't worth £10,000 next year. So, but even though you see the money, it's not worth that next year. You've lost it because the cost of living has gone up. You earn maybe 1 or 2% after taxes in the bank. So you actually need £500, for instance, if it's 5% inflation, just to stay.
Just to keep coverage. Just to break even, right?
Exactly. So there's investing is about making your money grow and work harder for you until you need it at some point in the future.
Oh, so you're leveraging it in the way, right?
Correct.
So you're constantly leveraging, right?
And yeah, and long story short, by investing, you're investing in good quality companies around the world.
So you're not just hedging on one particular segment or one particular sector.
100%.
So you're betting on different industries across multiple platforms.
Yep.
And different diversifiers go with it, right?
Yeah, so that, and also with gold, you've seen the gold prices go rocketing up. They're a good diversifier, and you might have heard of government bonds, corporate bonds, whatnot. There's also property in part of that as well. So you need to diversify.
If the internet went down
Yeah.
for 10 minutes, what would happen to the world?
Yeah.
Like, what would you do without the internet for 10 minutes? Just that. That's it. Whilst everything rebooted and sorted itself out, how would you physically function? And I know for a fact there's like 14-year-olds out there who lose their minds because their phones aren't working, because they don't know how to do anything else. Yeah. Right? Because that's their world. But businesses, telemetrics, flight paths, all that kind of jazz, right? How would it work?
Yes. Again, it depends on what are you actually going to do with that cash should anything go wrong. 9 times out of 10, everything now is digitally done. So you can get away with a lot of transactions without having to have cash, okay, in the short term. However, if it was 4 or 5 days worth of outage, what do you then do?
It boils down to how much resilience do you have within your plan, your path, or your system you set up in place just to ride through the wave right now.
Yeah, and I'd quickly add to that, your emergency fund.
I talk about emergency. What is an emergency fund?
Your emergency fund is should anything go wrong over a 3-month or 6-month period, you've got funds available that you can get at a drop of a hat.
So these are short-term investments, instant access?
Instant access is the key word. Not really investments, because investments
before we go further into that, define the difference between an instant access and a non-instant access account. What is the difference between, so people don't understand, they can just...
So instant access means that you can, let's just use the apps at the moment. You log into your bank account, you transfer money from one to another, or transfer that money to a product or provider, whatever it is that you need money for.
You can get it instantly.
You can do it within seconds and it's done. The accounts where there's a bit of a delay, so there's a 30-day notice before you can draw any money out, or there's a 12-month time frame. There's a 7 to 10 working days. So investments, depending on what product we've put your money into, I can get money out for you within 7 to 10 working days. Okay, so again, you always need something that you can touch immediately, whilst the other investments then start to kind of filter and come in.
Ravi, we've had some questions sent in to us whilst we're doing this podcast today. The question I have for you is, or I have, but the viewers had today was, what percentage or what income should they invest?
So what percentage of their income should they be investing? So this is a really, really good question. And this is probably the basic starting point for any client that I have. You need to understand your income and your outgoings. Okay. So like any business, you need to know where the money coming in and you need to know what's going out in expenses. For how much to invest depends on how much money do you need for your essential living and your non-essential living. Okay. So what I mean by that is rent, council tax, mortgage, bills, everything like that is essential. That has to be paid on a monthly basis. The non-essentials are really going out, buying clothes, things that you could potentially do without. Okay, so understand holidays. You need to live life, but if you're going on 7 holidays a year and you're not doing any savings, then something is not quite right. Okay, so have a look at that first. Ideally, what you want to be doing is finding out what your disposable income is. Okay, once you've figured out what needs to be spent each month, and 50% of your disposable income you should be putting away for long-term growth. Okay, and you should be thinking at least 5 years into the future, that's the pot that should be going away. The other 50%, so of the money that you're not spending, you should then be either building up an emergency fund or thinking, after this 12 months are gone, what do I want to be spending the next 12 months on? So we mentioned holidays. So start planning ahead for next year's holiday.
So you're working on a 50-50 kind of scenario.
Correct, yeah. If you can increase that, because if you've never done any savings at all, trying to do 50%, it's quite hard. So hence start with 50 and then work on that as you move forward, okay?
And then it also boils down to, what age should you start doing this? Or what age should you start investing in your pension, thinking about it?
As soon as you're born.
Really? So literally, the minute you're born, you start opening a pension fund?
Yes. Your parents should open up a pension for you, okay, when you're born, right? Everyone is allowed a pension at any age.
Really?
Yes. You can just imagine the compounding growth of £100, even if you just put £100 in when a child is born to when they're age 60 or 65, and you invested into a high risk strategy, and we can go into that in a moment, you will be astounded by the amount of compounding growth you'll get on that.
Wow. Okay. So literally, as soon as you're born, get a pension. You heard it here first.
So, and off the back of that, don't worry about buying your kids expensive clothes and watches and whatnot. Just do one pension for 1 year, and you will be amazed at the growth that will come out of that.
Interesting. Very interesting. So that's the best way to start.
Yeah. So from zero, correct. But pretty much as soon as you've got a full-time job, part of that 50% that we're talking about to save, just make sure you're either paying into your company pension scheme or you have your own standalone pension scheme, because the earlier you start,
and that's the best way to start building wealth.
100%. 100%. Yeah.
And then also, once you've built this wealth, obviously you talk to people towards the end of their careers.
Yeah.
What's the best way to pass this wealth down?
What I normally tell my clients is, ideally, I don't want you ever to pass the wealth down, because I want you to spend it and have an amazing life. Okay. Where the wealthy and ultra wealthy do really, really well, they're thinking 3 or 4 generations down the line. Okay. Some only think about, okay, how can I make my kids better off? And that's where things start, fall down a little bit. If you're thinking about my great grandchildren, you're setting up a legacy. Okay. So you don't need to worry about passing on the wealth. Just have a great lifestyle that you need. And generally speaking, there's people in the 80s still enjoying playing tennis, going out, having a fantastic life. But any amount from, 75 to 80 onwards that you feel you're just, this part of money I'm never going to touch, let's start to plan for the
So that's
the
where it comes to
generation.
someone like yourself, look at trusts and other options to go with it. And without getting into further detail, that's a whole
No, I mean, look,
together.
yeah, tax rules are always changing, but you don't want to then impact the next generation. So you really need to think about, when you do pass on wealth, how are you going to impact that generation and the generation after? So that's where you want to really think about strategically, how are you going to place.
It's hard to make IFL work sexy, isn't it? It's literally hard to make this conversation or this topic really interesting and jazzy and bring it back home again, right?
What do you mean? I said live your life. You want to live
but
your
it's
life.
just numbers. Like we do numbers at the other end of the scale. So we get excited about people spending their money or investing it and growing their businesses. But yours is more at the other end of the scale, right? So they enjoy it.
They've enjoyed their life, and now they're thinking about, how can I continue that legacy of passing it on to the family? It could be anything. It could be watches, it could be a house, it could be cars. whatever wealth you've accumulated, how can we pass
Just
the
build a
on?
legacy, right?
And it is sexy. Thank
See,
you very much.
it is sexy. Fair enough. On that note, thank you very much for watching our show today, and thank you, Ravi, for coming along. Please subscribe and continue watching more content.